Welcome to the daily insights that matter. Now, after surpassing the ambitious export target of $400 billion in the month of March, India's merchandise exports are now slowing. Let's understand why. Now, on a month-on-month basis, India's merchandise exports fell 17% to $29.78 billion in the month of October from $35.45 billion in the month of September, while imports, on the other hand, declined to $56.69 billion from $61.16 billion in the same period. Now, the merchandise trade deficit, which is the gap between the exports and the imports, is 66% higher than $17.87 billion in the month of October last year. India's exports are impacted due to rising inflation, the Russia-Ukraine war, and the supply chain disruptions which are hurting economic growth worldwide, leading to poor demand. Now, the dip in October was a seasonal dip as the trade was impacted by the Diwali and Dussehra festivities, which disrupted domestic productions. However, the sustained rise in imports, albeit at a slower pace, suggests that domestic consumption still remains stronger than in many parts of the world. Now, given the backdrop for global growth, the prospect for India's exports does appear uncertain at this point in time. The trade deficit and the current account deficit are also likely to be impacted by higher imports, which are growing faster than the exports. However, in the long run, numerous free trade agreements recently signed by India, the PLI scheme, and the shifting demand from China all augurs well for India's export economy. Now, in a difficult year that had been marred by sharp inflation and rising interest rates amidst a Russia-Ukraine war, the domestic markets have firmly regained ground, with Sensex and Nifty indices reaching 52-week highs. Now, the chart on your screen reflects how Indian stocks have diverged from China and emerging market peers like never before. The Indian stocks appear to increase their lead over global peers, emerging as a safe haven during this year's global equity rout. Now, India has been able to decouple from other emerging markets thanks to a number of factors, including unprecedented boom in the retail investments. Now, given all the problems we see in markets globally, India is being seen as a safe haven. India's domestically driven economy is based on underlying fundamentals like the favorable demographics, which will benefit the country's market performance going forward as well. The government's broad promises and structural change are the foundation of the market's improved performance, and the good news is anticipated to keep coming in going forward. So what does all of this news mean for you? The country's export prospects are now uncertain due to the macroeconomic climate. However, we think India's exports would be on the rise once the global headwinds subside and the policy initiatives take shape. Therefore, this will have an indirect neutral impact on you for time being. Now, as key indices test their 52-week high levels, India's domestically driven economy, which is based on underlying fundamental strength, will continue to grow and support the broader market performance going forward as well. This will have a direct positive impact on you. While I say this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.